All right, market update for Tuesday, June 11th. Frankly, I see a lot of people who are very cautious, people who are concerned, they're nervous at the slightest little downtick in the stock market. They're ready to sell, they're ready to cash out, they're ready to call the next market crash like 2008. In the economic commentary that I have seen, almost universal or close to being universal in recession outlook, very, very probable, highly likely, all the big Wall Street firms talking about recession now. From what I could see, given current conditions, and I don't think they're going to change anytime soon, but given current conditions, and specifically I'm talking about the record historic level of fiscal support. I mean, unless that changes significantly, and I don't see that happening, although we have to see what the 2020 budget is going to look like. We won't see that until the end of September. But right now, given the historic levels of fiscal support, I just don't see any of those dire things happening that everybody is talking about. And the stock market has gotten people sufficiently nervous and sufficiently frightened. Like I said, any little downtick, they're ready to sell, they're ready to, jump out. Very, very nervous right here. If we talk about the fiscal support, it's really important to understand this, because the main things in there, Social Security, Medicare, Medicaid, and defense spending, which I'll talk about in a second, but the three that I just listed, Social Security, Medicare, Medicaid, not only are those all non-discretionary, meaning they're just going to get paid no matter what, but because we're seeing the baby boomer generation reaching retirement age now, the recipient roles of those programs, Social Security, Medicare, Medicaid, are just going to be expanding for like the next 10 to 15 years. And right now, those three things alone comprise about half of all government spending, and they're just continuing to expand. Now, when you throw in defense spending and war, which under a Trump administration, you're not going to see that decline. In fact, we've seen massive increases in defense spending and war spending since Trump took office. That is also being treated like a non-discretionary expenditure. And as long as Trump stays in office, if he gets elected in 2020, you're going to continue to see massive military budget increases. So when you put all that together, Social Security, Medicare, Medicaid, and defense, you're talking about 3/4 of all government spending, which is well over $4 trillion. And I mean, at that level, which we've been at since 2009. Remember, prior to 2009, the net spending by the government was about $2.4 trillion annually for many, many years prior to 2009. Then we had the Great Recession, and with the Obama stimulus and everything, that jumped up to over $4 trillion. And we've been above $4 trillion annually, and actually now we're approaching $5 trillion. But that number, $4 trillion, seems to be like the magic number. That has supported the economy without any economic downturn, without a recession for 10 years now. And economists, they're scratching their heads at this. They don't understand why this cycle has been that long. I find it fascinating, really, because I look at it and to me, it's very obvious. And it's also very obvious why it's going to continue, because as I said, those programs are just going to continue to expand. So the fiscal support is just getting greater and greater and greater. Now, that might not mean a boom of 5% growth, but, this year we've been around 3%. Maybe we might fluctuate a little bit lower here in the second quarter because of all the uncertainty caused by the, Trump's tweets and the trade war, etc. But it's not enough to knock it into recession. So this is the proverbial wall of worry that you hear often talked about on Wall Street with respect to the market. The market always climbs the wall of worry, right? When people are nervous, it keeps creeping up, It always looks like it wants to crash or go down. People get nervous, they bail out, they sell, they go short, but then it just keeps creeping up. And every little correction 5%. We had a 7% correction in May. I mean, this is normal. 95% of the time in the history of the stock market, every single year has seen at least a 5% correction in the major averages. So 5%, 7%, that's completely normal. Completely normal. But people are on pins and needles. They are so scared. They are so afraid. They are so nervous that any little slight downturn, they're ready. That's it. I'm bailing out. It's going down. So this is the environment we're in right now. It's a positive environment. It doesn't look positive. On top of everything, you have Trump with the tweets and the trade war, and you have all these dire forecasts. And then you have what's going on with the bond market and the inversion there and the yield curve, and people saying that is the ultimate predictor. That has never failed us. Well, guess what? I have not seen one person other than myself talk about the impact or the influence of the debt ceiling on what is happening in the bond market and yields. It's amazing to me. I gave the example in my other video. What happens if OPEC decided not to sell any more oil? The Treasury cannot sell bonds. It has created an artificial shortage of the most important collateral on earth. For me, it's quite easy to understand. It's pretty humorous when I hear all of the so-called explanations as to why this is happening and how this is, this portends a horrible economic outcome because of the inversion. The inversion was caused. Treasury can't sell any more bonds. There is an artificially imposed limit. The debt ceiling. There's a ceiling. They can't. And this collateral is necessary, needed by financial institutions. You understand? The banks have to have this to meet stress tests and other regulatory requirements. They have to. It's mandated, statutory. So you make a condition where A, they must have these things, and B, you're not selling them anymore. You're not creating any more of them. And what do you think is going to happen? At the same time that Fed is reducing reserve balances, which makes it even more immediate and necessary that they have tier 1 assets, and there's not enough there. So I mean, for me, it's very, very basic and easy to understand. But then again, it all is, because through the understanding of MMT, and by the way, what I'm talking about goes even beyond MMT. You don't hear any of the MMT people talking about this. All right, I have taken MMT to a whole new level. Whole new level. With the understanding of reserves and the regulatory and all that stuff. So there you have it. That's what's going on. And frankly, I love the caution and I love the fear that's out there. I feed off of that. Feed off of that. Take their money. It's easy. It's easy in that regard, but I'll say this. Sometimes, even I, who's been in this game for a long time, who has high levels of mental game, very developed mental game, there's stress. You got to fight against that. When things get tough, when things get emotionally tough, you got to push against that. It never gets easy. I said this a million times. The easiest trade you'll ever have was the last trade you closed out at a profit. Every single one will test you to the max. And it's your job. You know what trading is? You know what the job of trading is? Mind control, self-control, mastery of oneself, control over one's emotions, control over your behavior, nothing else. It's not the analysis, although my analysis is the best. It's about self-control. And I'll leave you with that today.